Kirsty, and I am co-manager of the Baillie Gifford US Growth Trust, a trust that's looking to invest in the most exceptional growth businesses in America, regardless of whether they happen to be in public or private markets. So my starting point today is to try and address some of the big questions potential investors in the US might have. So why the US and why now? Why the US Growth Trust? Why are we excited? What do we own? And is this a dream opportunity? So let's start with why the US and why now? And we think there are 6 key reasons. The first is that the US will remain the best hunting ground for exceptional growth companies. It has all the ingredients necessary for a healthy innovation ecosystem. It has the best academic research institutions in the world. It has a strong talent pool supplemented by immigration. It is still the country for talented individuals who want to start a business. It has a well-developed venture capital system, strong IP protection, and a very friendly business environment. And finally, there's a culture of optimism and ambition and a willingness to accept failure. Second, we are in the middle of a once-in-a-generation wave of technology-led change. And that's driven by the internet, which has increased connectivity, mobile, which has increased availability, and artificial intelligence, which has made machines smarter. And these new technologies are early in the breakout from being deployed in just a few sectors, such as advertising and e-commerce, into legacy sectors like energy and chemicals, transportation, and the wider economy. Of course, over the next decade, almost all sectors of the economy will be reshaped, and it is innovative companies which are driving this change that are going to thrive. So third, many of the structural changes that were underway prior to the pandemic and which were accelerated by the pandemic continue. These shifts are not broken, and most are still very early. So commerce and education will continue to shift online. The transportation and energy sectors will continue to shift to cleaner and greener technologies, and the healthcare sector will continue to become more personalized, driven by genomics. Ultimately, this transition will never be smooth, and volatility is expected, but in many cases, this is just noise, temporarily masking these much more powerful underlying structural shifts. Fourth, the technology is the single most important driver of progress. During the pandemic, it was Moderna's mRNA vaccine that accelerated our path out of that crisis. And there are many problems left to solve, and technology represents our best hope to do so. Whenever we find solutions to existing problems, new problems just tend to emerge, and our willingness to tackle these iteratively with innovative ideas is at the heart of human progress. Over the last 10 years, solar prices have declined by almost 90%, and battery costs have fallen by almost 2/3. The more we are producing these products, the cheaper they are becoming. So our 5th reason is that share prices follow fundamentals over the long term. And you can see that here in the slide that we are showing on the screen here, that ultimately in the long term, the companies that are driving the most significant return are in the highest quintiles of growth. And finally, stock market returns will continue to be described by power laws rather than normal distributions. Over the long term, stock market returns are dominated by a small number of outlier companies that do extremely well. And we believe the asymmetry in stock market returns will be at least as pronounced over the next decade as it has been over prior decades. The power laws in equity investing occur because success begets success. So why the US Growth Trust? So the trust structure allows us to search for the most exceptional growth businesses in America, regardless of whether they happen to be public or private. Up to 50% of the portfolio can be in private companies. And these are not 2 people in a garage in Palo Alto. They are some big names, and I'll come on to a few of them a bit later on. Now, there are 3 core tenets of our investment philosophy. We are long-term, we are active, and we are growth. Great businesses are not made overnight. Thus, we try to own these businesses in a long-term manner, buying great companies and having the patience to wait for the exceptional characteristics of these companies to be reflected in their share prices. We are growth because we believe that superior profit growth leads to outperformance in the long run. And we are active because bottom-up stock selection enables the exploitation of inefficiencies. And one such inefficiency is the US stock market. Academic papers and our own internal work illustrate that it is a small number of stocks that drive all the return in the market. And the further you extend out your time horizon, the more profound this effect is. And we look to exploit this inefficiency. Consequently, it's not about how often you are right, but how much you can make for clients when you are. And this makes sense, but you have to be good at identifying these firms. Otherwise, it's just a needle in a haystack problem. Fortunately, we believe that these exceptional growth businesses share some common characteristics, whether they are private or they are public. First, they are addressing large and often expanding market opportunities. Second, they have or they are building strong competitive positions. And finally, they have distinctive cultures. They are often run by individuals who care about the vision, not the short-term share price. So why are we excited? So while the market focuses on what has become known as the Magnificent Seven, we think about the market in a different way. We think about the structural trends we believe are driving future progress. The future of commerce is the largest exposure we have in the portfolio, but this exposure stretches players like Amazon in consumer commerce to specialty vertical players like Chewy in pets, Wayfair in home, and Oddity in beauty, and even property players, commercial and residential, like a company like CoStar. But we are not just excited about commerce. There's also the new enterprise as we shift from on-premise to the cloud and we embrace AI, the digitization of entertainment when we see whether that be gaming or streaming or business-to-business tools that help facilitate that, the future of transportation as we move towards electric vehicles, and a healthcare evolution with the emergence of platforms and much more personalized medicine. We're also excited because the fundamentals of our portfolio are really shining through. The biggest contributor to our performance in 2023 was Shopify, the commerce tools platform company. The company transitioned to profitability in 2023, delivering a strong free cash flow margin for the full year. And the company did this whilst continuing to make investments in AI. Then we have Wayfair, the home company, which has returned to growth in a declining home industry and has delivered 3 quarters of adjusted EBITDA profitability. Duolingo, the language learning app, grew its daily active users by 65% last quarter, whilst only spending 14% of its revenue on sales and marketing. The company saw its free cash flow margin reach 27%, and they are guiding for strong growth. And finally, CoStar, the residential and commercial property business, has continued to deliver double-digit revenue growth against one of the worst property markets that we've seen in decades. And at the same time, the company is counter-cyclically investing its more than $5 billion cash pile. So what do we own? I'm going to talk to you today about companies that move stuff. So one moves stuff on the ground, one moves stuff in the air, and the other one moves stuff in space. So DoorDash is an online food delivery company. It operates in restaurants, it delivers food from restaurants, from grocery chains, and from convenience stores. It operates a 3-sided marketplace, which connects consumers, suppliers, which in this case is often things like restaurants, and delivery drivers, or what they call dashers. The company is a rare combination of ambition and operational excellence, a necessary combination in an industry where getting the economics to work is extremely tough. So what DoorDash offers to each of those constituents is a digital solution, an app for consumers to order on, software to help restaurants manage orders, and routing software to direct drivers to and from pickup locations. But DoorDash's product, by its nature, is physical. Food is a physical good. Consequently, DoorDash's digital offering is grounded in an understanding of the physical business and operations. Efficiency and thus margins come from an understanding of that physical side of the business. They have to know how to get drivers to a restaurant at the right time by the most efficient route and to get that product to the consumer as efficiently as possible. The company generates a substantial amount of free cash flow and continues to invest in its newer offerings, such as grocery and international. Furthermore, the competitive environment is softening. As unable to fund losses, weaker competition is exiting the market. Then we have Zipline. So Zipline is a drone delivery company, and it was the Trust's first ever private investment. When we invested in Zipline in 2018, the company's operations were predominantly in Rwanda, where its autonomous drones played a pivotal role in delivering medical supplies, specifically blood, to hard-to-reach locations. Fast forward to 2024, Zipline serves more than 3,400 hospitals and health facilities globally. While initially focusing on medical supplies, the company has expanded into e-commerce alongside animal and agricultural products. Zipline is now the largest autonomous drone delivery company on Earth, having flown over 40 million commercial autonomous miles, and has made twice as many deliveries in 2023 than all previous years combined. And with Zipline's home delivery system launching in the US last year, they really are just getting started. And finally, we have SpaceX. SpaceX is the largest holding in the portfolio, not just the private segment of the portfolio, the entire portfolio. And SpaceX designs, manufactures, and launches reusable rockets into space. Last year, 80% of the mass sent into space was put into orbit by SpaceX. Of the remaining 20, the majority was sent to space by nation states. Its key innovation is that it has made rockets reusable. And for those who have not seen one land, I would recommend looking it up. It's a pretty awe-inspiring sight. The reusability of SpaceX's rockets has transformed the unit economics of putting mass into orbit. Take the analogy of the aviation industry. Imagine the cost of an aviation ticket if every time you flew to London from New York that they scrapped the plane at the other end. That was the space industry before SpaceX. SpaceX has now used some of its rockets more than 10 times, and one of its Falcon rockets has been launched more than 15 times. And this reusability enabled them to launch Starlink, a low Earth orbital satellite constellation to deliver fast broadband to just about anywhere in the world. It has 2.3 million customers as of December 23, and each of those is paying around $100 a month for the service. And Elon Musk has recently said that the business has reached cash flow break even. And we believe this business is at the beginning of its growth opportunity. Just think about the size of the global broadband industry. And this company only has 2.3 million customers right now. Starlink is doing something no other company can do because it can leverage the launch business to provide the cost advantage to put thousands and thousands of satellites into space that are needed to make this a global business. So to bring this to a conclusion, the British physicist David Deutsch said, "We have a duty to be optimistic because the future is open. It's not predetermined and therefore cannot be just accepted. We are all responsible for what it holds, and we take that responsibility seriously. The trust holds the public and private companies which are determining that future. It will take time, and the path to success will not always be straightforward. But we believe the companies we invest in are well positioned to negotiate that path and realize their potential." To the moon is a phrase used online to express the expectation that the price of a particular asset will increase significantly. Never mind to the moon. We say to Mars. Thank you for listening.